Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, all. Ira Epstein of Lynn & Associates with your agriculture update for this Tuesday, the 19th of December, 2017, and we're just after 4:30 p.m. Central Standard Time. Well, the bean market's sort of relentless on this break, down to 955 low today, 956 last, so it's not a very Merry Christmas for soybean farmers. What more can you say? Keep in the back of your mind that on Friday, I believe, we have both the cattle on feed and some pig numbers coming out. So for those of you in the livestock arena, pay attention to that. Today, we did get passage in the House of Representatives so far of the tax bill. Unfortunately, it's at the Senate in a debate. It will probably pass there. And then because of a procedural mix-up of some type, it has to go back to the House to be voted on again. Sounds crazy. I don't recall seeing something this big that misses on a procedural whatever they say, but it's what it is. So as we look at the markets, let's take a look and see what this all means. First off, on our weekly area chart of closes, you can see how the market keeps slipping down from the most recent high, not this one back here, but the most recent of 994.25. We're now down in approximately 40 cents. As you take a look at the most recent daily area chart of closes, 1020 all the way down here. My gosh, that's pretty big. But remember, the other chart is a weekly. It uses the Jan contract. This is the March. You can see how prices have just gone into a skid. The hard thing is, because I know we talking here every morning when we first get in, how do you get involved? Where do you put a stop? That's the hard thing. The last rally high on swing lines was 993, and unless you take swing lines and you understand my course, you would not see that. That's the beauty of them. They let you figure out exactly how to do it by hand if you wanted, but then this will do it. So until 993 is violated, you have a pattern of lower highs, lower lows, which is bearish. The market is under the 18-day average of closes, my 18-day MAC. That is bearish. And as we talked, you spent 3 days trying to fight at the 100-day average for support. You gave up, and it has just let go ever since then. Where's the market? It's running along the lower Bollinger Band. Now, here's what running means. This is what we'll call sideways action in Bollinger Bands. Bollinger Band is an algorithm that I display in the black dashes that give you theoretical resistance and support areas. To get a trend going, you eventually have to come out of sideways action. But it's from sideways action that most trends develop. Now, if the market's going to push down on the bottom, it's got to push out that Bollinger Band and get under it typically. Getting under it only occurs 5% of the time. And when you do it in successive days, that percentage number comes down and starts shrinking till you get to the point where you can say, okay, there's probably near 0% that it's going to stay under the Bollinger Band on one of these days. I teach this in my charting course and learn it there. In momentum, you have now what? Both numbers are going sideways, as you see here, that make up the slow stochastic under 20. That's today's action. That's yesterday, the day before. You've got at least 3 days. That means it's embedded. Embedded means the market is switched over from being oversold to locking in a downtrend, which ends when the red line gets back over 20. In other words, you often get a pattern where if it was going up and over 20, or like here, under 20 for a number of days, the red happens and the market starts lifting because you've lost that selling pressure. Does it always work that way? Nah, I wish I could tell you that everything always works a certain way. The only thing that works a certain way is taxes and death. After that, most of the time is a good enough word. What do you do as a chartist? You're not looking for certainty. You're looking for the most of the times. Then you're measuring dollar risk. It's like a flight pilot. When I was flying, you'd have a checklist. Guess when you checked everything off? before the plane took off the ground. It doesn't do you any good once you're in the air. So before you put the trade on, you're looking at all these different steps. In the meal market, finally down to the 100-day average, lower Bollinger Band, but getting oversold. So we're getting to a point in this market where you might see traders say enough's enough, I'm going to cover shorts, whatever it is. Today's low was 319. You just missed the lower Bollinger Band at 317.17. You missed the 100-day average by 20 cents. I mean, close is good enough to me. You're in that zone. Soybean oil's bouncing because the meal's getting hit. You know, it's called a crush spread. And in crush spreads, you take the soybean, you crush it, you're going to get oil, you're going to get meal. The bean itself doesn't do you a lot of good. So unless you're like me and you put them in a BB gun and there's a kid and shot them, but that's another story. Lower highs, lower lows. Air guns are what we really, remember those old pop guns? In any case, higher lows, lower highs. I don't see anything that I'd want to do there as a trader. In the corn, it's bearish. What do I mean? When I'm looking as a setup to be for my advisory service, and people saying, where should I buy, where should I sell? I'm ideally looking for patterns that have lower highs and lower lows if it's in a downtrend, higher lows, higher highs in an uptrend. Then I'm filtering it with the 18-day average, and then I'm looking at momentum. The last thing I do is say, okay, if you get involved here, what's the ratio on risk to reward? And if you think you can go short here and 345 roughly is enough for you, fine. But you're getting down into corn where the ranges are so narrow. At 2 cents a day, I'm almost to the point of saying, you know, let the market come out of this low volatility and you take another look at it. In the wheat market, you got up to right where you should stop. Now, let's take a look. This is an embedded reading right through there. Notice right here, both numbers, all the numbers, in fact, have been going sideways under 20. Watch this. You get up, you close over 20. That puts into play the 18-day average of closes as long as the red line doesn't close under 20 the next day, which it doesn't. So now, in my theory, price and the 18-day average should hit each other. That number's 425. Today's high was 424. You missed by a penny. Didn't do it. But it's close enough to tell me, okay, I'm in a ballpark. You're still oversold. There's no reasons to be long, but you haven't had a reason to be short either. You've had reason to cover shorts when this happened, right back here. When this happened, where you're at 2091, the market was 418. You're looking for the 18-day average. Why are you hanging around? That's part of how I teach in my charting course. Sugar market caught today. Cleared 1402. Now, will it stay with the embedded reading lost? The odds are favorable that it will because you're up to a 25. The target should be here, the 1450 area, and we'll see if it carries or falls apart after it hits that. But my guess is they caught the shorts in this market today. You didn't start an uptrend, you caught the shorts. Haven't done that in coffee. You still got lower highs, lower lows, but you lost the embedded reading. So unless this market falls back pretty fast, there could be a problem here in what this market does one way or the other. I'm also looking, this is May coffee, not the March. They must have done something just now of changing a contract. This is May coffee. I'm looking right up at the symbol. I've got that wrong and I will fix that. I know that prices didn't do that in the March. In the March cocoa, higher lows, higher highs. Take a look at this right here. You lost the embedded reading. So you got a number of markets that have lost the embedded reading. Part of the reason could be what's going on in the dollar, and I'm going to get you there in a minute. You lost the embedded reading yesterday. You're following through. If my theory holds up, price and the 18-day average should come together. Now, you lost it right here too, right where I'm pointing, and it never did get to the 18-day average. 2 times. I'll bet that the market is what? Still saying to you, even though it rallied like that the theory's there, and we'll see if the market wants to make that run. In the cattle market, you got up to the 18-day average, hit the brick wall. You lost the embedded reading. You've hit your upside target. It's just sort of sitting. In the feeder cattle, I want to go to yesterday's action. You lose the embedded reading. You get up to the closest of the main averages, which is the 100. Will the market embed again? Today it does. It falls right back into that embedded status. Does it have to go back up here to challenge that again? Well, in theory, it doesn't. The embedded reading takes over, and if you can clear the 142.80, you might even be into a washout phase. Get over the 147.09 level, and you probably turn the slow stochastic back up. You'd be over key averages. You could catch the shorts in that way. In the hog market, right on back, where did you fail, by the way? So often I talk about this, that 18-day average. Look at how the battleground shaped up, and today you just fall apart again. I'm not saying that this was a trend trade, but I am saying that 18-day average deserves respect from a lot of people. What I was saying in the dollar index is it's down today, and if you look at my other videos, you're going to see that it left its uptrend as the euro started an uptrend. So, interesting day. Maybe that's impacting some of these softs. I discuss all this in detail in my charting course. My charting course runs $109.95. It includes $99 worth of software, $60 worth of my market research for 30 days. It's $150 by itself. Then you've got 6 hours of videos where I start teaching you the different parts of the course. And the course is based on 5 technical indicators. They are, first, you always hear me talking about my friend, the swing line. I developed it, so I think I'm the most qualified to teach you about it, and I teach an awful lot about it. Next, you'll have moving averages. I don't know why we're getting that right now, but something's happened there. The slow stochastics, you know that I talk about them. I learned them from my good friend, George Lane. Then, Bollinger Bands, John Bollinger, know him as well. And what's the market did? We've got a video card issue that's taking place there, but let me make life very simple for you. You get the research. You get access to my morning subscriber videos. All my writings come into you for all this for the 30-day period. It's normally $109.95 for the course. As I said, just by itself, my research is $60, and then the charting's $90. $109.95 reduced down to $79.95 as long as you use the word XMAS in the coupon area. Go to our website. You'll see under the word education, drop down, you'll be there. You can also click right up here if you'd like. If you're watching me on YouTube, it'll take you right to the page. I'm Ira Epstein. Sorry about that video card issue, but what the heck, it's just an ad. You have a great day, and I'll see you all tomorrow.